Hey everyone, thanks for tuning in. I wanted to take a few minutes today to talk about what's been happening with Bitcoin recently, especially since some of you hold it in your portfolios. You may have seen the recent headlines. Bitcoin dropped from over $126,000 back in October to as low as $60,000 last week, early in the morning of February 6th. After hitting that low, it rebounded to about 70,000. Peak to trough, that's more than a 50% decline in just 4 months. Last week saw the biggest single day drop since the collapse of FTX, one of the largest cryptocurrency exchanges, back in 2022. Our chief investment strategist, Larry Swedroe, recently wrote an excellent analysis on this, and I wanted to share some of those insights with you because I think they're really important. Now, I want to be clear up front. We don't use Bitcoin or any cryptocurrencies in the portfolios we manage. Some of you have it because you wanted exposure or because you were worried about missing out. And that's totally fine. It's your money. But I think what's happened recently gives us a chance to step back and look at what Bitcoin actually is versus what we've been told that it is. For years now, the cryptocurrency industry has made two major claims about Bitcoin. First, that it's an inflation hedge. That's because there's a limited supply. It should protect your purchasing power when the government prints money and prices rise. Second, that it's digital gold, a modern technological version of the safe haven that gold has been for thousands of years. These aren't just random talking points. These are the core reasons people have been told to buy Bitcoin, not as a speculation, not as a gamble, but as a legitimate part of a balanced portfolio. Here's the problem. Both of these claims just fell apart. Let's talk about the inflation hedge claim first. Think about what an inflation hedge is supposed to do. When prices are rising and the dollar is losing purchasing power, an inflation hedge should hold its value or go up. That's the whole point. Right now, inflation is still running above the Fed's 2% target. We're in exactly the environment where an inflation hedge should be working. And what did Bitcoin do? It collapsed by half. Compare that to actual inflation hedges. Treasury inflation protected securities, TIPS, mechanically adjust with inflation. You're guaranteed protection. Commodities often rise with inflation because they're the inputs that cause inflation in the first place. Even real estate tends to appreciate as construction costs go up. Bitcoin did none of this. It crashed during the exact conditions when it was supposed to protect you. That's not an inflation hedge. That's a failure of the inflation hedge thesis. Now let's talk about the digital gold narrative. This might be the most successful marketing campaign in the crypto industry. The idea sounds great. Bitcoin is like gold, but better because it's digital, more portable, easier to divide. But here's what actually happened. While Bitcoin dropped 50%, gold soared. Gold was up 64% last year, and it's still up about 10% this year, even after a recent pullback. Think about that. If Bitcoin really were digital gold, wouldn't they at least move in the same direction? Instead, they did the opposite. The reason is simple. Gold is a safe haven. When markets get scary, people buy gold because it's been valuable for thousands of years. Bitcoin is the opposite. It's a speculative asset. When risk appetite disappears, Bitcoin crashes. These aren't two versions of the same thing. They're fundamentally different assets that behave in fundamentally different ways. So why did the industry promote these narratives so aggressively? Because they had to. Think about the business model. Exchanges, the places where securities like stocks and bonds are bought and sold between investors, make money on transaction fees. Miners, basically the people running the computer networks that make Bitcoin work, need high prices to stay profitable. Early investors and institutions that bought Bitcoin cheap want new buyers to drive the price up. ETF providers collect fees based on assets under management. Everyone in the ecosystem profits when more people buy Bitcoin. And it's much easier to sell Bitcoin as inflation protection and digital gold than as a highly volatile speculative asset with no intrinsic value. So they created these narratives. They marketed them relentlessly, and a lot of people believed them. Look, I'm not here to tell you Bitcoin is going to zero. I don't know where it's headed, and frankly, nobody does. What I am saying is this. Bitcoin is not what you were told it is. It's not an inflation hedge. It's not digital gold. It's a speculative bet whose entire value depends on whether someone else will pay more for it tomorrow than you paid today. If you own Bitcoin, that's fine. Just understand what you own. It's a high risk, high volatility asset that can swing wildly in either direction. Don't hold it thinking it's protecting you from inflation or providing a safe haven, because it's not doing either of those things. For the portfolios we manage, we're sticking with time-tested assets that have proven track records, diversified stocks, bonds, real assets such as real estate and infrastructure, reinsurance, private equity, etc. Things we understand, with fundamentals we can analyze, and risk characteristics that make sense for your goals. I know this might be frustrating to hear, especially if you bought into Bitcoin based on these promises, but I'd rather have this honest conversation with you now than let you continue operating under assumptions that the market has proven false. As always, if you want to discuss your specific situation or have questions about any of this, just reach out. That's what we're here for. Thanks for watching. I'll talk to you soon.